ADUs are magical, but financing them is hard. This video covers everything you need to know to get off the ground exploring financing options to build your own ADU. I'll share real-world experience spanning decades. In 1997, I was 3 years into my lending career when my hometown of Portland, Oregon made ADUs legal, and hundreds of my clients have built ADUs. You can too. ADUs are amazing. You can pay for them with the rental income they generate. Give yourself a quiet place to work from home, bring your family together with multi-generational housing, or give yourself a place to downsize into when you retire. And you may use it for a lot of these things, more than one or all of them over the years. And of course, every ADU built adds one more much needed unit to our limited and increasingly unaffordable housing supply. But to make this magic happen, you have to get your ADU built, and to get it built, you have to find the money, and it's a lot of money. ADUs are not cheap to build. It seems like they should be because they're so tiny after all, but every ADU includes all of the expensive bits of a house, the kitchen, the bathroom, the utilities, all delicately arranged in a tiny package. So the sooner you start doing your homework, the better. You don't want to start writing checks to design an ADU you can't afford, and diving into construction without a handle on the budget and a plan for financing can be a recipe for disaster. Some of the short-term solutions that seem so easy can make longer-term financing more expensive or difficult to obtain, or both. And if you get started and then run short of funds in the middle of construction, some of the options you would have had earlier shut down. And I'll talk about all of this. The good news is there are a lot of ways to find funding to build an ADU, and they fall broadly into three categories. The way I like to organize them in my head is outside funds, equity you already have, and equity that you create. And I'm going to go pretty deep on each one of these. So this isn't going to be a short video, but you can use the chapters in the caption below to skip around and jump to what's relevant or interesting to you. I'll cover pros and cons for each option, some practical tips, and give you a rough idea of the cost for each. But before I do that, I'd love to invite you to like and subscribe. It'll make me happy to know I'm sharing useful information and help the algorithm put this information in front of more people who could benefit from it when planning to build their ADUs. And remember, as you listen to this, that I'm a loan officer licensed in all 50 states. If you want to talk through your own situation, I'm available to consult. There's a link in the description below that you can use to schedule a call. So let's get to it. I want to talk about outside funds first. So what do I mean when I say outside funds? These are sources of funds not coming from equity in real estate. And sometimes these sources could be a long-term answer. Other times they may be a temporary funding source that you'll need or want to replace with permanent funding later on, which might fall into one of those other categories. Outside funds can, of course, include the easiest thing of all, if you've got it, cash on hand. And if you're lucky enough to have enough savings on hand to build your ADU from cash, I guess lucky you, and nice job saving, and why are you watching this video? If you don't have enough cash on hand to fully fund your ADU, like most people, you'll probably wind up paying cash for at least some of the initial costs. Fronting the cash for your design or permits or some of the initial site work can reduce what you have to finance later. One good source outside of cash for outside funding is retirement accounts. They're a good potential source of outside funds. If you've not already done so, check and see if you have a retirement account that has a loan provision. If you're still working and have an employer-sponsored plan like a 401k, most offer a loan provision. If yours does, you should be able to borrow 50% of your vested balance up to $50,000. Loans from retirement plans are a cheap and quick way to set up funds for an ADU, and they don't trigger taxes. After taking one out, you just pay yourself back through payroll deductions. You should also have the option to pay the full balance off anytime you want, but it is really important to understand that if you get laid off or change employers and you can't pay the loan back, it'll be treated as a taxable distribution, and that could be an unpleasant side effect of using this as a long-term solution if you're planning or are forced to change jobs. The other thing to remember about taking a loan from a retirement plan is that you're paying yourself back at what is probably a relatively low interest rate. And if the funds that your money would have been invested in otherwise is at a higher yield than that interest rate you're returning, then you lose a little bit in the differential. If the market's yielding 10% and you're paying yourself back 5%, while that loan's outstanding, you're missing out on that 5% difference. So the sooner you can pay a retirement loan back, generally the better. Now, of course, another option is to just take a distribution from a retirement account. Pulling funds from a retirement account to build an ADU can be a really cool way to set yourself up with affordable housing for retirement. It's kind of, a great way to leverage retirement funds for retirement, literally in your own backyard or maybe in your kid's backyard, or by creating rental income to make your retirement more affordable. Just don't forget to budget for the taxes that you'll owe if you take money out of a retirement plan. You should be able to take penalty-free withdrawals from an IRA or other retirement plan if you're 59 and a half or older, or if you take funds from an inherited IRA. And if you're a first-time buyer, up to $10,000 of withdrawal from an IRA can sometimes be penalty-free as well. Most IRA withdrawals will be subject to some income tax. Now, the exception to that would be withdrawals from a Roth IRA. Roth IRAs are funded with post-tax dollars, so qualified distributions can be tax-free. And there are some other more exotic options with retirement accounts too. I'm not going to go deep on these, but a self-directed IRA can be used to fund construction of an ADU at an investment property, or maybe even make a loan to a third party to build an ADU. And an off-label application of the rules that let you roll over an IRA from one brokerage to another can unlock access to an IRA for a really short period of time, 60 days or less, without a tax hit. But there's some complications to this, and you're kind of flirting with disaster if you can't get the money back in and are subject to tax. You'll want to check out all the rules applicable to this for your situation with your tax advisor and the administrator of any retirement plans that you have. Now, another source of outside funds would, of course, be family and friends. If anybody is willing and able, you can enlist their help to fund your ADU with outright gifts or loans. If you borrow money from family as a short-term loan, kind of a bridge loan during construction, make sure you have a solid game plan for repaying their generosity. You don't want to assume that you're going to qualify for a new loan to pay them back and then find out there's some kind of problem. Plan ahead. Reach out to a lender, me or someone else, and get pre-qualified. That way you and your loved ones will know that you've got a plan for getting that money back to them already mapped out ahead of time. And although it's not necessarily ideal, many ADUs are built with at least some funds borrowed from credit cards. Commonly, the need to tap into credit cards will kind of pop up during the end of the process when other funding sources have dried up and you need to finish or furnish your ADU. Credit cards and personal lines of credit often come into play, but honestly, I've seen more than one ADU financed entirely on credit cards. If your plan is to use credit cards as a stopgap that you'll refinance or consolidate later, be really careful. Rapidly running up credit card balances can wreck even the best of credit scores, even if you've never had a single late payment and your credit is perfect. Sneaky language in most credit card agreements allow your bank or the credit card holder to hike the rate on what you owe if your credit score falls below a certain threshold. And that's true even if you, again, haven't missed a payment. And if that isn't bad enough, a lower credit score resulting from that credit card debt can then make refinancing to get your cards paid off more expensive or impossible. There can be a really terrible negative feedback loop here that you absolutely want to avoid. If you're going to use credit cards for that last push to finish up an ADU and you're counting on refinancing to consolidate your debts, you may be able to get strategic with the timing of your refinance application. Credit reports are valid in most cases for mortgage purposes for 120 days. If you apply for a refinance and have your lender pull credit before you've run the balances up on your credit cards, but within 120 days of when your project will be complete and ready to refinance, you may be able to use your earlier, prettier, better credit score from before you ran up the credit card balances and increased your debt to qualify for the loan. This is a little bit of a game of chicken with timelines, but it can yield really big savings on your loan. Let's move on to talking about another popular set of options, ones that rely on the equity you already have in your home. If you've owned your home for long enough for it to have appreciated, which these days may not be that long, property values have gone up so quickly, or maybe you made a really big down payment when you purchased, you may have enough equity sitting in your home to build your ADU. The trick is figuring out the best way to liberate it. And there are three options: refinancing, setting up a home equity line, or setting up a home equity loan. So let's talk about each one. Refinancing replaces your existing mortgage or mortgages with a new, bigger mortgage. When you refinance, your old mortgage and any other financing attached to your home get rolled into a new, bigger loan. Your old loan gets paid off and you get the difference in cash back that you can use to build your ADU. When you refinance, most loans allow you to borrow up to 80% of the current value of your home. To get an idea of the equity you have available, just multiply the current value of your home by 0.8 and then subtract the balance of your current mortgage or mortgages. Closing costs for a refinance can vary a little bit from one area to another, one state to another, and also with the type of loan that you're taking out, but $4,000 or $5,000 is a pretty good ballpark. You're not going to pay these costs out of pocket. They'll typically be just subtracted from the cash back that you get at closing, and your lender will itemize all of these costs and estimate the net cash back that you're going to get on a document called a loan estimate. When you refinance, you're truly starting from scratch with all new financing. That means you can pick any new loan terms you'd like. You can have a fixed or an adjustable rate. You can take out a loan term from 10 to 30 years, and you'll also have the opportunity to use the cash back that you get for other purposes. If you've got some higher interest credit card debt or a car payment or a student loan, you could potentially roll these other debts into your mortgage to reduce the interest rate or monthly payments or both on those. Even if you don't consolidate other debts, refinancing to a new 30-year mortgage is often the path to the lowest overall monthly payment. But starting a loan over again can add to the overall interest that you pay. And if you're building your ADU to rent out, I always suggest, or at least, recommend looking into options for 15 or 20-year loans. With the added rental income, it may be possible to take out a shorter mortgage and still make ends meet. If you can swing the payment, you'll generally get a lower interest rate and tons of interest savings on a shorter term mortgage. But of course, if you were lucky to score a really low interest rate on your current loan, refinancing is going to mean letting go of that low rate and going to whatever current market rates are. If you refinanced in 2020 or 2021 when rates were at all-time lows, you really probably shouldn't let go of that 2-point-something or 3-point-something rate you have locked in. If you're 62 or older, you should be eligible for something called a reverse mortgage or home equity conversion mortgage, or because we love acronyms in lending, HECM for short. Most mortgages that you would refinance into are a forward mortgage, which means you take out a loan and you make monthly payments that cover the interest and a certain amount of principal. But with a reverse mortgage, you only have to pay the property taxes and insurance on your home. The interest on the loan actually gets added back to the balance, so the loan gets bigger each month you have it. There are pros and cons to this option. These tend to be really expensive mortgages to set up, and they may not be the best option if you're counting on your home equity to buy into an assisted care facility or you hope to leave your home to heirs. But if you want your absolute lowest monthly payment and the lowest possible overhead, it's pretty hard to beat an option that doesn't require a monthly payment. So let's say you do have that incredibly low interest rate locked in on your mortgage. You don't want to do a reverse mortgage or you're not eligible for it. What are the other options we would have to tap into the equity you already have? Well, home equity lines of credit, or HELoC for short, or a home equity loan, sometimes called a HELoan, is another option. These are second mortgage programs. This means they get recorded as a second lien against your home, behind and subordinate to your existing first mortgage. Because they're separate from your first loan, you get to leave it in place as is, same rate, same payment, same everything. So if you've got that great rate on your current mortgage and a new loan would be at a higher interest rate, a HELoC or a HELoan, home equity loan, might be a great way to go. These programs can vary from lender to lender, and they're really less uniform than a lot of the refinance or first mortgage programs we talk about. They're generally a portfolio product. Most mortgages are securitized. After your loan closes, your lender turns around and sells your loan to an investor as a bond. Portfolio lending is different. The lender, which is usually going to be a bank or credit union, is truly lending their own money to you. This gives lenders a lot of latitude to make up whatever loans they want to. They can make up all the rules, their own rules with their own money after all, but they may also be a little more conservative in their lending standards to protect their interests. They're taking on more risk. Most home equity loan programs, HELoC programs, will let you borrow 80 to 90% of your current property value. To estimate what you can borrow, take your current property value, multiply it by 0.8 or 0.9, and then subtract the balance of your current loans. But when you go to apply for one of these in the real world, don't be surprised if your lender lowballs your property value a little bit. Estimating a little bit of a lower property value is one way that a portfolio lender can be a little conservative and protect themselves. A HELoC should be pretty cheap to set up. Closing costs are often $1,000 or less. Sometimes they're even free, absolutely no cost to set up. And one cool feature of a home equity line of credit is that it is a line of credit. You pay no interest on a line of credit until you draw funds from it. As you build your ADU, this is a perfect use. You need a little money to get started. You draw what you need. You pay interest on what you've drawn. And as you go and you draw more as you're building the ADU and you need more funding, then you're only paying interest on the amount that you've actually spent. Unlike a credit card, a home equity line of credit has a set period of time during which you can take draws. This is called the draw period. 10 years is pretty common, although I've seen lines where the window is a lot shorter, as little as I think 3 years is probably the shortest I've ever seen. And one place where you'll find a lot of the variability with home equity lines of credit is the minimum monthly payment during that draw period. Some credit lines require a payment that is a percentage of the outstanding balance. And this is pretty common with credit union credit lines in particular. 1% of the balance is pretty common. I've seen as high as 1.5% of the balance. And if you do the math and kind of calculate the cost of a typical accessory dwelling unit, somewhere between maybe $150,000 and $300,000. On a $300,000 ADU, a 1% minimum payment would be $3,000. At the other end of the spectrum, there are home equity lines of credit that allow an interest-only minimum monthly payment while your line is open to draws. And this is really great for flexibility. It keeps your costs super low while you're building. But of course, if you're only paying interest, you never pay the principal down. So once that draw period ends, one of two things will happen. Some credit lines, this is rare, but some credit lines will have a balloon payment due. And that means you're going to owe the balance in full, whatever you owe at the time it's closed to draws, all at once. More commonly, you'll enter what's called a repayment period, where you're going to be required to pay installments that are sufficient to get the loan paid off over a set period of time. 10, 15, or 20 years is pretty typical. If you've only been paying interest only during that whole draw period, you're now going to have a big bump in your monthly payment as you have to start paying that loan down over whatever the remaining repayment period is. HELoCs can be really cool, but there are a few drawbacks to think about. First, they're generally a monthly variable rate. And like all variable rates, the interest you pay is the combination of an index and a margin. The index is the part of the interest rate you'll pay that moves, and the margin is a fixed number that gets added to that index, or if you get lucky, subtracted from that index to determine what your rate will be each month. The prime rate is the most common index for a HELoC. And so you'll have something like prime plus 1% as a home equity interest rate. That's kind of a common way to have it listed. This math is done every month. So you'll take the prime rate, in that example, plus 1%, and that'll be your new interest rate. Anytime the prime rate changes, your rate will change too. So if you hear the Fed has changed interest rates, then the prime rate's going to move. If the Fed raised rates 0.75%, next month your HELoC rate will be 0.75% higher too. As I'm recording this, the prime rate is 7.75%. So if you had that typical prime plus 1% HELoC, your rate today would be 8.75%. If the Fed increases the federal funds rate by 0.25% at their next meeting, then the prime rate would go from 7.75 to 8, and your rate next month would be 8%, the new prime rate, plus your 1% margin for a total rate of 9%. Now, most credit lines do protect you with a cap, a maximum rate that they'll never exceed no matter how high the prime rate gets, but the caps are really high. 18% is a pretty universal number that I see in most instances. So if you can imagine borrowing a six-figure sum at 9%, knowing the rate may climb further and wind up in the teens, that sounds kind of unappealing. And the higher the interest rate goes, the higher your monthly payment will be, especially once the interest-only line, if you have an interest-only payment, switches over to that higher payment in the repayment period. So the antidote to some of this is the HELoC's cousin, which is a home equity loan. Rather than being a credit line with a variable interest rate, a HELoan generally has a fixed rate, a fixed payment, and a fixed term. No variable rate to worry about and no changes to your monthly payment and never a balloon payment. HELoan rates tend to be higher than first mortgage rates, and loan terms are fairly short. 5, 10, 15 years is pretty common. I've seen some as long as 20, 30 is pretty unusual, and the combination of that higher interest rate and then the shorter loan term can make for a relatively high monthly payment. And of course, a HELoan is also something that's going to hand you all of the money at closing. So unlike a credit line, you don't get that easing into drawing funds from your HELoan. You're just getting a lump sum of money when you close it. But worth noting, a lot of HELoCs are kind of a hybrid. They start out as a HELoC and they have that revolving draw period. And then they offer you the option to switch some or all of what you owe on the HELoC over to a fixed rate and payment like a HELoan. My company offers a HELoC that automatically locks in a fixed rate and payment on every draw that you take out, and these hybrids are not unusual. When thinking about a HELoC or a HELoan versus a refinance, there's an important concept to consider, which is something called a blended interest rate. Think of your blended rate as a weighted average of the interest you're paying across all of the dollars that you borrow. If you're a visual person, imagine pouring all the money you owe on a first mortgage and all the money you owe on a HELoC into a bucket and then stirring it around. If you reached in and grabbed a dollar, the blended rate is the rate you're paying on kind of an average dollar weighted over the different interest rates on the different amounts of money that you've borrowed. This is especially relevant today because so many of us locked in amazingly low interest rates on our homes during the pandemic. If your first mortgage is locked in at 2 something or 3 something, that low rate acts as a counterbalance, kind of some ballast that'll offset the higher rate you'll have to pay on a HELoC or a home equity line or loan. So let's say you need to borrow $200,000 to build your ADU, and you have a $500,000 existing mortgage locked in at 3.25. Should you refinance or take out a HELoC? Now let's imagine you could refinance at 6%, but the best rate you could get on a HELoC is 9%. That 9% HELoC interest rate sounds like a terrible deal, but it's not. It's actually the better deal. Keeping your 3.25 rate and borrowing another $200,000 at 9% works out to a better blended rate, below 5%, a whole lot better than that 6% refinance you could get, and also probably with a lot less closing costs. So if you need to calculate a blended rate, you can reach out to me, or there are tools online. There's information in the caption if you want to reach out to me. I can help you work out the math. So what if you don't have enough equity in your home, a pile of savings, or a rich uncle willing to fund your ADU? It's time to look into renovation and construction loans. These loan options allow you to borrow from the future value of your property, including the value you create by building your ADU and any other remodeling you do. Sometimes folks will fold in, improvements to the main house while building the ADU. These types of programs weren't developed with ADUs in mind. I think of them as almost an off-label use, but they can work beautifully. Construction loans are generally used to build a new home from scratch, but they can be used to fund major remodeling projects, including the construction of an ADU. The construction loans that I really prefer and work with most often are typically called construction permanent loans or one-time close loans. As these names imply, they're an all-in-one construction loan that includes the permanent financing you're going to carry into the future with a single closing. They start out as a construction loan and last during that construction period, most often 9 to 18 months. And during the term of construction, you pay an interest-only minimum payment on the amount of the loan outstanding. And that sort of eases up just like it would on a HELoC, the example we talked about before. When construction is complete, the loan converts to long-term financing. It rolls over usually to a good old-fashioned 30-year fixed rate. Expect your lender on a construction loan to get all up in your business. We want to know what you're building, who's going to be swinging the hammers, and then we're going to closely oversee the project because we're basing our financing on your home as improved. It's risky for us to lend on something that doesn't exist yet, so micromanaging things mitigates that risk somewhat. I recommend applying for a construction loan at least 90 days before you need funding. You should begin the process, I would say at the very latest, as you're wrapping up your design and getting quotes for construction. Working on the loan concurrently with that last phase of design and costing allows you ample time for these extra hoops that you're going to need to jump through and the extra paperwork that you're going to need to provide for a construction loan. Your lender will ask you for all the construction documents for your ADU, the floor plans, the elevations, material lists, and your contractor is going to need to provide a fixed price bid broken down between labor and materials. If your contractor prefers to work on a cost plus basis and isn't willing to provide a fixed cost bid, they're really not a good fit for a construction loan. Your loan's going to be for a fixed amount, and so the cost to build has to be pinned down really accurately so your loan can be based on it. If there are some loose ends in the bid, an allowance for certain items is okay. If you have an allowance for lighting fixtures and there's a dollar amount there. And if there are some unknowns to your project, your lender may allow you to build in a contingency fund on top of the bid. This is often the case if you're extensively altering an existing structure, an older home. Maybe you don't know what you're going to get into until you start demo. A contingency fund is something that they may permit you to build in. These construction documents are required before we can order your appraisal. We're going to send an appraiser out with a copy of the plans and the bid and ask them to tell us what the house is going to be worth after the ADU has been built. They need all of this detailed information to paint a clear picture of the finished product, the thing we're asking them to appraise, so that they can evaluate it and give us a value for it. Like HELoCs, construction loans are typically portfolio products, so the amount you can borrow is going to vary from one program to another. I work with a construction program that allows a loan-to-value ratio of up to 89.99% of the value of your new home, or I guess your finished home, including the value of your ADU. If you're poking at your calculator and trying to figure out how much cash this will net you for ADU construction, estimate what you think your home is going to be worth, take it times 0.8999. And don't forget to take into account that you have to pay off your existing mortgage. You'll almost certainly be required with a construction loan to work with an experienced, licensed, bonded, insured contractor. Your lender is going to run a little background check on your contractor to make sure they have good references and a resume that supports their ability to handle a project the scope of yours. And don't plan on doing the work yourself or hiring your newly licensed cousin. Closing on a construction loan can generally only happen after you have permits in hand, but whatever you do, even if you're getting impatient waiting for permits, please don't start work before your construction loan closes. It may seem like a good idea to get a jump on things and do some demo or some site work, but if you get rolling too early, your lender may refuse to close. This is not an arbitrary control freak thing on lenders' parts. If a contractor performs work on a property and doesn't get paid, in most states, they have the right to lien your property. Lenders care a lot about their lien position, so the possibility of a construction lien from work that started before your lender held the purse strings and was babysitting everything and started writing checks can actually be a showstopper. When you close on the construction loan, your old mortgage is going to be paid off. So in this sense, it's kind of like a regular refinance, but unlike a regular refinance where at closing, you are handed a big chunk of money that you can use to start building the ADU. With a construction loan, all of the extra proceeds are held by the lender. And then as work progresses, typically on a monthly basis, you'll submit a draw request asking your builder to be paid for the work that's completed. The bank will make a visit to the site, verify the work's been done, and issue a check. Draws are made based on the work that's been completed and installed on site, usually on a percentage basis. So if you've completed 100% of the foundation and 20% of the framing, it'll be paid out like that. There are some exceptions on a limited basis if you have to pay a deposit for cabinets or flooring or windows or some other material that has a lead time. But this desire on the part of lenders to only pay for things after they're installed on site can make construction loans a really tricky fit with some of the super cool modular and panelized and prefab ADUs that are proliferating out there. I love them, but a prefab ADU company is going to ask you for a big deposit to get started building your ADU, which is a perfectly reasonable request. They're basically building the whole thing off-site, and your construction lender, also being reasonable from their perception, doesn't want to pay for materials that aren't yet on-site and permanently affixed to the ground. It's really affixing these objects to the ground that converts them from objects in the world, which are personal property, into real property. And mortgage loans are only secured to real, not personal property. If you can come up with an alternate means of paying the deposit for a prefab ADU, whatever deposit the manufacturer requires, your construction loan can sometimes reimburse you for the money that you fronted once the ADU's been delivered on site and affixed to the foundation. So if you have your heart set on a modular or prefab ADU and you can't find the money for the deposits from one of the other sources we've already talked about, see if the manufacturer has any special relationships with lenders who are willing to kind of color outside the lines for that style of construction. And I should also mention that construction loans don't have to be a refinance. They can be used to purchase a property too. It's just that the lead time required to design and permit an ADU would require an unusually patient seller. It can take, months and months, if not a year or more, to get to the place where you'd be ready to close on a construction loan, given all the planning that has to happen to get an ADU ready to be permitted. And if all of this sounds like a lot of extra legwork, it kind of is for you and your lender, and all of that extra administrative effort comes at a little bit of a cost. You can expect the closing costs for a construction loan to be 2 or 3 times as much as they would be for a traditional refinance. And these are riskier loans for lenders. They're lending on something that doesn't exist yet, the future value of the property. So the interest rates are going to vary by program, but you can expect them to be a little bit higher than what you'd pay for a similar non-construction loan. But in exchange for the cost and all the rigmarole, you get to borrow against the future value of your shiny new ADU, which can make your shiny new ADU happen. The second type of loan that allows you to borrow against the future value of your home after the ADU has been built is a renovation, rehabilitation, or for short, rehab loan. The renovation loan process is actually really similar to construction loans, but there are a couple of key differences that make them quicker to close and overall a little more user-friendly. FHA, Fannie Mae, and Freddie Mac each offer really great renovation loan programs. The FHA renovation loan is called the 203K. FHA has this habit of naming their programs after the section and paragraph of the legislation that created it. So Section 203, paragraph K. The 203K is kind of the OG renovation loan. It has been around a long time, since the 1970s. I first started working with them in, I think, 1995, so I guess I've been around a long time too. But the 203K renovation loan allows you to borrow up to 97.75% of the as-improved value of your home, up to the FHA loan limit for the county that you're in. And yeah, that's 97.75% of the entire value of your home, including the value added by your ADU. So it's a really high percent of the value of your property, and a great way if you're tight on equity and tight on funds to find enough money to build an ADU. You can look up the FHA loan limits for your county using a link I put in the description below. And there's been a lively debate, and this is kind of an important side note. It's still sort of unsettled as to whether or not FHA rules will allow an ADU that is totally detached from the main house to be built. Different lenders interpret this guideline differently. If you want to convert a detached garage or build a freestanding ADU, you're going to want to ask your lender early how they're currently interpreting this rule, because it could be a showstopper. The 203K program is only available for primary residences, so if you're building an ADU at a rental property or a secondary residence, this isn't an option you can use. But there is a little known exception for HUD-approved nonprofits. If you're a nonprofit and you own ADUs and you're looking to, or own property and you're looking to build some ADUs, the FHA renovation loan may be an option for you. And FHA loans do have super flexible underwriting standards. This is true for all FHA loans, not just the 203K. If your credit is less than perfect, or your debt to income ratio, the percent of your income you spend on all of your expenses, including your mortgage and other minimum payments, is a little bit of a stretch, you may find that the leniency offered by FHA could be key to being able to secure a loan approval to fund your ADU construction. Now, not to be outdone, Fannie Mae created their own renovation program called Homestyle. In 2018, I think they made a bunch of important changes to the program, one of which was to explicitly allow freestanding ADUs. So there isn't any controversy about that like there is with FHA. And Freddie Mac followed suit with what they call the Choice Renovation Loan. Homestyle loans allow up to 95 or 97% of the improved value of a single-family primary residence to be financed, 90% of the value of a single-family second home, and up to 85% of a single-family investment property. And I should say, actually, although their guidelines say 85%, in the real world, for some practical reasons, investors really should plan on financing about 75% of the value of a single-family investment property. Annually, Fannie Mae and Freddie Mac set nationwide loan limits. They grant some exceptions to their loan limits in certain high-cost areas. These are easy to look up online. Homestyle and Choice Renovation, the Fannie Mae and Freddie Mac programs, work just like a construction loan. Once you provide plans, your contractors bid to your lender, we order the appraisal based on that future as improved value with the value of the ADU included. And your contractor's bid still has to be for a fixed amount. But all renovation loans, and this is true of FHA, Fannie Mae, and Freddie Mac, will include a contingency fund of somewhere between 10 and 20% of the construction costs for the ADU. These funds are there to address any surprises that pop up once construction gets rolling after closing. So if you're worried about the what ifs of trying to integrate an ADU into an older home especially, the contingency reserve built into these programs can make for a little added peace of mind. And then once you get over the hump with any of the possible surprises, you're through the demo and you haven't discovered anything that's going to use those contingency funds, you can actually spend unspent contingency funds on upgrades, maybe buy some nicer appliances or fancier lighting and plumbing fixtures, something that you can do toward the end. I think I had a client once buy a whole lot of really nice tile because they didn't spend their whole contingency fund when it came time to tile the shower. And any contingency funds that you don't spend on upgrades like that will simply be paid down on your loan after all the work is complete. Your contractor will be vetted by your lender, although that vetting is a little less intense than it would be for a construction loan. We're out of portfolio lending, and so it's a less intense review process, but they will need to be licensed and bonded and insured. And your bid's going to be reviewed by a trained consultant who will act as your lender's liaison to the construction process. They're an expert on construction and timelines and costs. We're experts at lending, so we like to get that extra set of eyes on the bid. The consultant will verify the bid's realistic, provide a construction timeline, and they can even offer you some consulting and coaching services as you try and determine feasibility for the project, pick a contractor, and settle on materials. Work has to start on renovation loan projects within 30 days of closing, but work does include submitting for your permit. Renovation loans standardly allow 6 months from closing to complete the work, so they're a tighter timeline than a construction loan, but some lenders are willing to grant an extension if permitting or material lead times or something else causes a delay. Unlike a construction loan, standard monthly payments start right away on your new loan. So you do have to start writing mortgage checks immediately. But if there's a period of time where you can't live in your home for some part of the project and your appraisal comes in high enough to support this, you may be allowed to finance up to 5 months of payments on your new mortgage into the mortgage, put into an escrow and paid out for you. And this can be a really nice feature that removes some of that financial pressure if you've got to find a place to rent and you're working through while you have to pay mortgage payments as well. The draw process for renovation loans is just like a construction loan. You'll submit a draw request to your lender. The consultant working on your transaction will swing by to verify the work is completed. Remember, they're kind of the lender's eyes and ears at the property. And then your lender will cut a check to pay your contractor. Because other than those limited exceptions I talked about before for cabinets and windows and flooring and things that have lead time, your materials need to be installed before the loan will pay a draw for them. The same challenges that I talked about before when it comes to making a construction loan work for modular, panelized, and prefab ADUs apply to renovation loans as well. The interest rates on renovation loans tend to be about 1% higher than those for a similar non-renovation loan. And this is true whether it's Fannie Mae or FHA or Freddie Mac. And you can expect to pay a few additional closing costs as well. The additional closing costs will vary based on the size of your loan and the construction budget, but $3,000 to $5,000 is probably a pretty good guess. One huge positive difference between construction loans and renovation loans is that renovation loans don't require a permit to close. For experienced lenders, renovation loans are pretty speedy to close. My team can close about 30 days after we have the plans and the bid in hand and order your appraisal. And as improbable as it sounds, it's actually possible to finance an ADU with the purchase of a home. If you have a pre-designed ADU and a bid from your contractor and the consultant's report, that's all we need to move forward with closing. And I can't forget to talk about appraisals. Whenever you're relying on the value your ADU will add to the property to finance it, the value you're creating with the ADU, it's so important to understand that ADUs are notoriously tricky to value. Lenders want appraisers to use comparable sales as an indication or the way they determine value. To be a comparable sale, or a comp as we call it, a home has to be near to yours in proximity, similar to yours in style, and that includes having the ADU, and have sold in the recent past, ideally within 3 to 6 months, maybe 12 at the outside. And this can put appraisers in a really tough spot. There are more homes with ADUs out there all the time, of course, but they're still kind of few and far between. But the real big issue is that to be a comp, a home has to be a sale. It has to have sold. And people generally only go to the trouble and expense of building an ADU because they want an ADU. You just sat here listening to me talk about ADU financing for however long when you could have been watching some other fun Mr. Beast video or something. So if you got this far into this video, you're probably pretty invested in making your ADU happen. And once you have it, you're not gonna sell it, you're gonna hang on to it for a while. And so comps with ADUs can be few and far between. As you plan your ADU, it's a good idea to keep an eye on the area around your home and maybe enlist the help of your favorite real estate broker and cross your fingers that a home or two with an ADU will sell sometime around the time you want to develop your project. It will make your appraiser's job significantly easier. And although I hope this video gives you some insight into the options available, please like and subscribe. If so, it is no substitute for talking with a knowledgeable, creative lender who works on these loan options, understands the challenges of financing ADUs, and knows how to pull the puzzle pieces together. If you'd like to talk with me, see the caption below for a link to schedule a call and a list of the information to gather up before we chat. Most ADUs are built using a combination of the options I've outlined in this video. After taking some time to understand your project and your resources and your goals, we can work together to develop the right plan to make the ADU of your dreams a reality.